Michael Burry, the famous big short, has done it again. He bet big against the American stock markets by buying put options for $1.6 billion. That's what many of you have heard, but did he really? Apparently, according to the 13F filing by his Scion Asset Management Fund, released just yesterday, Michael Burry has bet big against the US stock markets by buying put options on both Nasdaq and S&P 500 in the second quarter. Now, what does that mean? Why did he do that? And how can you use this information in your advantage? Watch till the end of the video to find out the answer. Michael Burry is a former hedge fund manager that has gained fame by successfully predicting the 2008 subprime mortgage crisis. His contrarian investing style and ability to identify the market trends has led to substantial profits during that period. Portrayed in the book and the movie The Big Short, Burry is known for shorting the US housing markets by betting against mortgage-based securities and credit default swaps that were derived from the subprime mortgages. This move earned him hundreds of millions of dollars at the time, and his actions often attract attention due to his unique insights and ability to take unconventional positions in the market. Now let us take a look at his portfolio so you can get an idea how it's changed in time, what is its size, and what is his investment style. As you can see, his portfolio is rather smaller and tends to fluctuate a lot. But on average, I think he invests around 120 million at a time. And in second quarter of 2022, he accentuated his bearishness by selling off all the stocks that he owned but one, the GEO. There you can see the most recent 13F filing that was published yesterday by his Scion Asset Management Fund. And as you can see, he purchased put option contracts against the S&P 500 and also against the Nasdaq Composite. Now, to be more specific, he bought put option contract against 2 million shares of SPY in the notional value of $886 million. Now, do not mistake, the notional value is not the same as the premium that he actually paid for these contracts. The premium that he actually paid is much smaller. And secondly, he bought put option contracts against 2 million shares of QQQ in the notional value of $738 million. And again, let me repeat, this is not the amount of money that he actually paid for those put contracts. The premium he paid for them is much smaller. Without expiration date of those puts, and without the strike price, we cannot tell how much Burry actually paid for those contracts. If I had to guess, I would probably think it cost him around $40 to $80 million, which is by no means a small position in relation to his portfolio. The notional value of the put option, which is what you actually can see on the screen, is actually the total value of the underlying asset from which the option contract is being derived. So in other words, Burry bought 20,000 contracts per each index. One contract refers to 100 shares for the premium that is usually significantly lower than the value of the underlying asset. Let me quickly remind you how the put option contracts work so you can better imagine what this trade is all about. So in the picture you can see the diagram of long put. In other words, when somebody purchases the put option, and this diagram shows his potential profits and losses. A put option is a financial derivative contract that gives you the right but not obligation to sell a specific asset, be it stock, commodity or indices, at a predetermined price in the specific period. It is essentially a form of insurance against the decline of the underlying asset's value. If the asset's value fall below the predetermined price, which we call the strike price, the holder of the put option has the right to sell the asset to the issuer at the strike price even though the market value of that asset has declined significantly. This allows the option holder to profit from the difference between the strike price and the market price of the asset. However, if the value of the asset were to increase above the strike price, the holder of the put option stands to lose 100% of the premium that was paid for these option contracts. This will not usually bankrupt you, like in case of the shorts, but it is still a significant loss. So in case of Burry, he has bought a put option contracts with unknown strike price and unknown duration. Therefore, we cannot tell what he paid for those contracts, but it was some portion, some small premium that he paid for each contract. Michael Burry has paid premium to be able to profit from falling price of the underlying asset, which in his case is SPY and QQQ. So in other words, if the share price or SPY or QQQ goes down, it goes down only when the indices, real indices, go down, then his profit will rise. If his prediction comes false and the share price, underlying share price, doesn't go down and it goes, let's say, up, if the markets decide to rally, then the Burry will bear a loss equal to premium. As you can see, even though the share price can go high, very high, his loss will be always limited. So essentially what Burry did here is that he bought a safer variant of shorts. Instead of shorting the stock markets, he bought the put options. And as you can see from the diagram, his downside risk is limited. It may tell us that Burry is convinced that the markets are due to go down, but he's not that convinced to actually short this position, which would increase his potential losses. So there might be really three reasons why Burry has decided to buy these option contracts. The first and traditional use of these contracts is to hedge your other positions in your portfolio. So when other positions that rely on the market growth go down, your put option contracts will allow you to profit from this downward movement. The second reason may be that he just decided to trade the market volatility that has increased as of late. And third, and the last possibility, is that he has decided to buy these contracts because he has truly negative outlook on the US markets. But bear in mind that this feeling just gives you an idea of what he did during the second quarter, i.e. between the beginning of the April and end of the July. In fact, he might have actually already closed these positions, and we're reading too much into his trades. But at the same time, it would not be too wild to assume that Burry has bought these options due to his bearish positioning. If you followed his Twitter account, you would know that he's pretty bearish. And he has been bearish especially during the last year's slump. So, in conclusion, there's really not enough information to tell what did Burry intend by buying these put options. There are many possibilities for why he might have bought them. So beware of making the assumptions and wait for the next filling. If in the next filling you see that these option contracts were not closed yet, it increases the probability that he is truly foreseeing the bleak future to the stock markets.